Welcome to InvestoPads. In 2022, China's economy reached a staggering $18 trillion, surpassing the US's $25.5 trillion, as per the IMF's purchasing power parity data. China's contribution to global GDP stands at 18.9%, exceeding the US's 15.4%. Throughout 2022, the US-China trade reached a remarkable $750 billion, but it also resulted in a significant merchandise deficit for the US, coming in as the second highest on record, just behind the $419.4 billion deficit in 2018, as reported by China's General Administration of Customs. William Reinsch, a former senior official at the U.S. Department of Commerce under Clinton, and now a senior advisor at the Center for Strategic and International Studies, believes the data reveals that American consumers have a strong affinity for Chinese goods. Over the months, Americans have been eagerly purchasing and hoarding Chinese products. A report indicates that a staggering 9 out of 10 items bought by Americans come from China. Forbes sources suggest that this trend applies to various items, such as toys, sporting goods, and clothing available in the U.S. market. The impact of this buying frenzy is evident in U.S. warehouses, which have been operating at record levels for months. More than 260,000 merchants have stockpiled substantial quantities of various Chinese-made goods, making it clear that Chinese products hold an indispensable position in the U.S. market. Chinese dominance in the global supply chain is also evident in key industries, including steel, solar panels, electronics, coal, plastics, buttons, and car batteries. Their presence in the automotive sector is notable, with auto exports doubling within a mere 2 years, especially in the electric vehicle segment. Chinese goods have carved out a niche for themselves in the U.S. market, with some consumers expressing a strong dependence on these products. They believe that only China can offer a complete industrial chain, making their goods irreplaceable in many cases. This scenario reinforces China's position as a vital player in the global economic landscape. China has solidified its position as the world's largest exporter of automobiles. Moreover, many of China's goods hold an irreplaceable position globally, exemplified by the U.S. Department of Commerce's announcement on July 5th, opposing export controls on metal commodities, gallium, and germanium. The data clearly indicates that China is a leading player in both reserves and exports of these metals, serving as the largest producer, with gallium accounting for over 95% of global production and germanium accounting for more than 67%. China's influence extends to key raw materials, where it serves as a major producer of 20 crucial elements, while also dominating in the fine processing of these materials. One significant concern for the U.S. economy is China's control over the global processing and refining of rare earth metals, with Chinese companies holding sway over about 90% of global rare earth production and supply, and around 80% of the U.S.'s rare earth supply. A July 7th report by Goldman Sachs Bank indicates that Western countries might need an investment of over $25 billion to meet their rare earth supply needs. Replicating China's annual production of 50,000 tons of rare earths could cost the West between $15 billion and $30 billion. Moreover, the projected global demand for neodymium and praseodymium, 2 rare earth elements, is expected to potentially outstrip supply starting in 2028 due to the rising demand from electric vehicles and wind turbines, with these applications projected to account for 50% of the demand by 2030. China's impact is also felt in the financial and monetary sector, as it holds a significant position in the global economic landscape. Its dominant control over key raw materials and reserves, along with its substantial holdings of U.S. debt, makes it a crucial player with substantial influence on the global stage. The largest holders of U.S. debt. In October 2016, Japan overtook China, holding the top position for 8 months until China reclaimed it in June 2017. However, since June 2019, Japan has once again become the largest holder of U.S. debt. As of April this year, China had been the second largest holder of U.S. debt for 47 consecutive months. Considering Japan's holdings of $1.1272 trillion, which account for approximately 90% of its total foreign exchange reserves, Japan has limited room to increase its holdings further. Recent years have seen Japan running trade deficits and experiencing an increased demand for cash dollars, leading to the need to sell U.S. debt in exchange for cash dollars. On the other hand, China's foreign exchange reserves reached a significant $3.193 trillion by the end of June, with $868.9 billion of U.S. debt, accounting for about 27% of those reserves. This indicates that China has a larger capacity to increase its holdings compared to Japan. Moreover, there are indications that China is actively increasing its gold reserves on a large scale, while at the same time, it is replacing U.S. debt, which is a core dollar asset, with gold. This strategy reflects China's efforts to diversify its holdings and reduce its dependence on U.S. debt in favor of other assets like gold. In June, China significantly increased its holdings of gold reserves by 680,000 ounces, bringing the total gold reserves to 67.95 million ounces. This increase marks the 8th consecutive month of China's growth in gold reserve holdings, with a total increase of about 165 tons. Despite this rise, China's gold reserves, which now constitute 4% of its foreign exchange reserves, remain considerably smaller than those of Germany, France, Italy, and other European countries, which have percentages as high as 65% or even higher. Even compared to the U.S. gold reserves, which account for nearly 69% of their foreign exchange reserves, China still has significant room to increase its gold holdings. This trend poses concerns for the U.S. debt situation. After extending the debt ceiling in June, the total U.S. federal debt surged from $31.4 trillion to $32.34 trillion as of July 7th, resulting in a $940 billion increase in just 1 month, as reported by the U.S. Congressional Budget Office and the Department of the Treasury. Furthermore, by the end of this fiscal year on September 30th, the United States is projected to issue nearly $750 billion in national debt. With the U.S. economy already deeply entrenched in debt, reducing dependence on it becomes challenging. To address these challenges, the U.S. Treasury has hinted at the possibility of issuing 100-year U.S. Treasuries in the future, extending the maturity of bonds from the current 30 years to 70 years. Consequently, the U.S. relies on major international buyers with substantial global power to sustain its debt-based economic model. Should the Federal Reserve and the domestic market be the sole entities supporting U.S. debt, it would hinder effective exportation of debt, leading to reduced global liquidity and a decline in the U.S. dollar's status as a reserve currency. Additionally, the Federal Reserve has been raising interest rates and shrinking its balance sheet. Federal Reserve Chairman Powell's repeated statements suggest a plan to reduce the holdings of U.S. Treasuries by $60 billion per month by the end of 2025. These measures further contribute to the complexity of the U.S. debt situation. The Federal Reserve, Fed, has undergone a significant shift in its role regarding U.S. debt. It has moved from being the largest recipient of U.S. debt to becoming the most substantial reducer of it. Japan, as the largest buyer of U.S. debt, is nearing saturation both domestically and internationally, making it unable to continue its role of taking over U.S. debt. Consequently, the U.S. Treasury appears to be relying on China to step in and increase its holdings of U.S. Treasuries. China stands out as the only country with the capacity to acquire trillions of dollars in U.S. debt. However, there are indications that China is deviating from this path, as it continues to sell U.S. bonds on a large scale while simultaneously bolstering its holdings of gold. This shift suggests China's intention to reduce its reliance on U.S. debt and emphasizes its efforts towards economic diversification, thereby challenging the U.S. dollar's hegemony. China's immense economic presence and its dominant position in the global supply chain make it a significant player in the global economic landscape. Its monopoly on key commodities and raw materials, such as rare earths, coupled with its considerable holdings of U.S. Treasuries, grant it substantial leverage in economic competition with the United States. This economic prowess has translated into enormous influence and agenda-setting power for China in the global economy. Furthermore, China's strategic decision to significantly increase its gold holdings while reducing its exposure to U.S. debt underscores its determination to break away from its dependency on the U.S. dollar. As the world's second-largest economy, China is resolute in pursuing economic diversification and aims to challenge the dominant position of the U.S. dollar in international trade. Thank you for watching this video, and we look forward to seeing you in the next one.